Good evening, all valued guests. I'm Jeff, your moderator for today, and thank you very much for your time to join us in today's webinar, Global Market at New High, What is Next? So as we are riding on a few market noises, a few to mention, the US tapering, which is very much anticipated, latest by the end of the year, issues related to US debt ceiling, China policy changes, and the recent possible default of the company Evergrande. Should we stay aside or should we stay invested? Now, today we are honored to have Mr. David Jong from Franklin Templeton to share with us his insights. Before we start, allow me to give a short introduction to Mr. David. David joined Franklin Templeton in 2015, leading the Malaysian retail business and distribution network. He carries with him 13 years of experience in investment and finance. Prior to that, he was with Aberdeen Standard Investment, ECM Libra Investment Bank, and CIMB Securities. David holds a bachelor degree majoring in mathematics. And without further ado, let us welcome Mr. David Jong. David, over to you.
Hi, Jeff. Thanks for
Hi.
having me. We'd like to say good afternoon to all of your valued clients, and thank you so much for joining us on today's session with Affin Bank. Feel very honored and looking forward for engaging discussion with all of you. So I think, ladies and gentlemen, in terms of global growth, what we're looking at right now is we'll continue to be positive on the ongoing recovery, especially on the global developed markets. On the emerging market side, I think we see variations of different pace of recovery, primarily because they have different level of vaccination progress. So if you compare that to the developed market, especially on the US, on the European Union, we got the UK side is doing extremely well on the pace of vaccination. So because of that, we have a different pace of recovery around the world. But by and large, because US is such a big component in the global economy, right? So in the global stock market index, US constitute close to 60% of market value. So as the word goes, right, if the US sneeze, the whole world will sneeze. So that is still true. But in the good news is that US is doing well, right? So granted, currently what we have at current juncture, if you look at this particular slide here, on the world GDP side, the US will contribute a significant amount of growth into this year. So if you look at the prediction here by our investment team and compare from the IMF forecast, so by and large, I think this year we are looking at 6% GDP growth for the world, right? US alone is expected to grow 6 to 7% GDP this year. To give you a sense of that figure, 6 to 7% GDP for US in 2021 full year, yeah, that would be the fastest growth since 1983. So I think Jeff, you probably you look younger than that, but since 1983, I think that's a fantastic rebound from US. Clearly, because they have vaccinated their people, their economy reopened actually way earlier. We are certainly based in the US, my head office in California. So, every time I spoke to my colleagues, fellow colleagues, they are certainly now we are towards the end of summer, right? During summer from May, all of them busy traveling within US. They are out and about dining, doing gym, etc., etc. So things are picking up in the US. It's important because US is driven by consumption. It's a private consumption economy driven. So it's important. 6 to 7% kind of GDP in US for this year is fantastic. So more importantly, going forward, right? Our take is on US will continue to grow, but at a lower pace of the speed. Currently, I think what we see in second quarter, US to a certain extent already peaked in terms of growth because stimulus all already pumped into the system. There's no more stimulus checks that are being released to the people in the US. So the economy recovered. So the governments, what they're going to do, they're going to stop all these stimulus check to the people and then let the economy grow on its own. So our take going forward into the rest half of this year and 2022, our take is the growth will continue to be above trend. That's the most important part, above trend. So if all of you happen to see the news that the growth in US will moderate, the answer is true, but compared to the long-term average, is still good news. So for example, next year, right, US is expected to grow. If you look at this chart here, I can see 3.5%, quite low, but market is predicting all in about 4% growth for US next year, right? So if the big boys, the biggest block in the room is doing well, the rest of the world should do just fine. But that will be selective, Jeff. It will be very dependent on the pace of vaccination progress and on the whether the threat of Delta variant will pose a threat to the pace of the vaccination in some of these countries, especially in emerging market. So that's on the world front. If you look at emerging Asia, they are doing well because if you look at the emerging Asia front here, a lot of these are championed by China. First in, first out. So they're doing very well on the vaccination front. And currently the focus of Chinese government is shifting to common prosperity goal, right? They try to manage the economy right now. So we can talk more about that later. But all in all, our take for emerging Asia, the North Asian countries are doing well. Taiwan, likes of China, Hong Kong, including Singapore is doing very well. One of the first to come out from this crisis. And the way Singapore is managing it, they accept that COVID-19 is here, but it's going to be endemic. But vaccination has been taken care of. They're doing very well on that front. So they are starting to living with COVID-19 in Singapore. So by and large, that summarizes US, the world, the Asia. On the European side, I think clearly they were one of the most hit last year, but they are bouncing back as well. So because by virtue of UK is doing well, France have vaccinated. I got a friend from Singapore actually is traveling in Europe right now. So I got jealous when I see her social media picture traveling around France right now. So clearly, developed market opening up way earlier than emerging market. So you can see pace of growth in the developed market is doing well at the moment, and we continue to believe that this ongoing recovery will continue to do well. So we can move on to the next slide. If you look at US front, I mentioned the growth will moderate, right? But it's still above trend going into 2022. So you can see on the right-hand side, what does Citi US Economic Surprise Index means. Means the number of economic data released that beating expectations are coming down already. So that is expected because currently US is already mid-cycle already, right? Earlier on, they were early cycle, recover from recession, early cycle, and this year they're moving to mid-cycle already. So mid-cycle means growth already peak, the stimulus already peak, and moving forward, the growth is still continue to be above trend, but moderating down already. Does that mean market will underperform? Not necessary, because the underlying fundamental of US economy continue to be supportive, and the backdrop is very favorable for US stock market in particular. So we speak more about that in terms of where do we see the opportunities in US, in other areas market of the world. But by and large, I just want to stress that the US is doing well in this current juncture. And going forward, while there are certainly threats from the pace of the recovery, whether Delta variant is going to pose a threat, whether what the US central bank, the Fed, is going to do on the tapering side and on the interest rate hike policy, by and large, I think this has been well communicated to the market, and we think the economy is well positioned to grow until next year. So we can move on to the next slide here. On emerging market, the good news is that while we see different pace of recovery in emerging market, that includes Asia, because the vaccination has been rather slow in certain markets in emerging market. But the good news is that the fundamental in EM is much stronger today compared to the past. So let's judge that based on the free cash flow, the first chart on the left. So if you see the figure, the blue bar is picking up, the free cash flow among emerging market companies are very encouraging. So it's very healthy. It's important is because when there's an economic stress environment, you want to have your company as healthy as possible. Free cash flow means the company is well financed, they are not in high leverage. So if any economic stress environment, they will be able to navigate the economic stress environment. So that's the first part, free cash flow. What about if you look at the breakdown of emerging market as a percentage of the developed market free cash flow? It's a good healthy pickup trend as well. So what we see in the emerging market today is very healthy on the free cash flow front, even outpacing the figures is increasing against developed market. Gone are the days whereby last time emerging market companies there's no substance into it, but today we would say emerging market today is much stronger than in the past. So it's a very encouraging trend on a free cash flow front. They are catching up with the developed market companies, the US boys, the European boys, and the Japanese boys. So what about on profitability? So we look at the far right chart here, that's return on equity. The higher it is, the better. As an investor, you want your ROE on your investment to be double digit, right? So let's look at what happened. There's a sharp dip because of COVID-19 last year, recession. So we compare ROE of the emerging market to developed market. If you look at the green line, that's the world index, which is the developed market corporate. So they recovered very well. So hence you see US market or European market all up substantially since last year. Where is emerging market? The blue line here, just slightly below the developed market. They were slower to recover, but it's coming already. So our take is the ROE front, I think emerging market is doing well. Developed market also doing well. So but we got to be selective because this is where the stock selection is crucial. You don't go outright and buy a US ETF or you buy a emerging market ETF, because while the ETF may do well as well, but this year I would say market has been rather selective in terms of which area is doing well. So I'm sure all of you can testify to that when you do your account review, your portfolio review with your Affin Bank advisors. You may realize how come certain funds is not doing so compared to the other fund which is doing well, because this year market is selective. I will explain more about that, but by and large, we see a very healthy trend in emerging market, both from free cash flow and the ROE front. Jeff, moving on. So I think I mentioned about the selectivity, right? And one of the key ingredients is that our belief in Franklin Templeton is that it's important when you review your portfolio with your advisors, with your RMs, you got to check, right? How many percent of your portfolio are exposed to the new economy businesses in the world? It's important is because businesses that we deem are high quality, sustainable earnings are the ones likely from the new economy business or segment. So I give you an example, right? I think the whole notion about digital transformation. Within healthcare innovation, we've seen the rise of biotechnology, for example. Even within the financial world, we've seen the rise of fintech, right? Even banks are, investing massively in fintech. It's because the new economy businesses are taking over the world. So this chart in front of you, what you can see is the trend for the last 10 years. The number of percentage of new economy stocks in Asia ex Japan and developed market. Look at the growth of Asia as Japan. Today, how many percent of new economy in Asia is 64%, very healthy. Sad to say, I would say for Malaysia market, a large chunk of our local stock market is still exposed to old economy. It's simple. When you go to our blue chips, how many of them are technology company? How many of them are fintech company? Most of them are in the old economy, like commodities, like traditional bank, for example, traditional utility like Tenaga Nasional. So those are the old economy companies. Yes, they may still survive, but their growth rate is no longer fantastic. So it's important from your portfolio. We recommend higher focus on new economy stocks. So look at developed market, also 64% currently, but Asia as Japan is fast catching up, right? So we see a lot of these companies in markets like China, Hong Kong, South Korea, Taiwan. On ASEAN, we see a lot more coming from Vietnam. It's a very fast growing market in Vietnam. So this way, we are selective in Asia as Japan. Yeah. So moving on, I think I just want to mention about, I spoke about the quality of the companies, the new economy companies. I also would like to highlight the resilience of the company in Asia and in developed market. So look at the earnings growth expectation on the left-hand side. Most of you probably during our Q&A, Jeff will ask, what's the upside going forward? Since our topic for today, global markets at new high, are there still room to grow? At the end of the day, stock market go up because corporate profits are there. Look at on the left hand side, the earning expectation is usually is still very healthy. Jeff. If you look at the MACI Asia as Japan, the MACI World, going forward, I think the earnings growth are still there. Yes, the magnitude of growth slow down because quarter two peak already. Q3, Q4 to 2022, if you judge based on an average level, it's still very healthy trend. So our tag in Franklin is that the earnings growth continue to be encouraging, both of at Asia market and the world market. Look at the right hand side. This is where I want to highlight. So it's important to dissect when we see the headline of our topic today. Global markets are at new high, but it's important to see not all markets are doing well currently. If you look at the PE or the price to book ratio, Asia market is still trading at a discount, to developed companies, MACI world. Negative means at the discount. So let's look at where are the discount right now. Somewhere between 20% to 40%, right? So the discount is still there, but I would encourage for you, it's important to maintain a diversified portfolio. Given what's happening with China, I think the crackdown will continue to persist, right? So that will impact current momentum in Asia, especially. So it's important to stay diversified. Don't forget your developed market. Just because they are trading at a premium to Asia doesn't mean you don't have any exposure to developed market. So it's key to maintain exposure to developed market, especially US. It's because the fundamental of the companies there are strong. We got healthy free cash flow from US companies and most developed market companies, and good earnings growth projection, despite they are trading at a premium to Asia. So it's important to balance out. After you saw this chart, I'll be quite worried if you move entire your pot to Asia. So it's important to maintain the US part. Jeff? So I think in summary, our view on Asia, we got resilient economy. So you got countries like Taiwan, driven by the semiconductor boom. We like Taiwan. Korea, the same thing. We see a lot of new economy kind of companies emerging from Korea. This year, I think one of the largest, I think in fact the largest e-commerce company in Korea, called Coupang, right? Coupang. They operate a lot of digital. They are like Amazon for Korea. So Coupang listed in Nasdaq this year, right? So also we look at Coupang quite a fair bit. So that's an example of resilient country. Taiwan, Korea, Hong Kong, China included. On ASEAN side, we like Vietnam, we like Singapore right now. So these are the countries that we see are doing well currently. So resilient economy in Asia, the corporates, the companies are resilient as well. Dividends are going up, profits growth are there, and their debt level also coming down. So all in all, we've seen a compelling valuation in Asia. But my only caution of advice is, don't forget your developed market companies. Moving on. I think on China side, I promised to touch about the regulatory crackdown. I think our view in a nutshell is that I think you may read some of the key points here, but all in all, our take is I think what China is doing is nothing new. It's similar to what they have done in 2018 and 2016. And by and large, I think global investors accept that this is part of the ongoing sort of transition of Chinese economy. And currently, they are embarked on this plan to pursue common prosperity for all of their people, right? So to do that, they need to do a crackdown on certain things when it comes to education, gambling, and the list goes on. So ultimately, what we're trying to do here is on our Asia portfolio, on our Chinese market exposure, we focus on companies that have addressed some of this ambition that Chinese government is doing. So we would prefer companies that are aligned with what the Chinese government is doing. So at the end of the day, we continue to like some of the Chinese companies that we like. We continue to focus on their secular growth, the trends that we are seeing, especially Alibaba, Tencent. These are the names that we really like in our portfolio, right? So, but my advice is need to be patient. I think the way this thing is developing, I think it remains to be seen how long this crackdown is going to last. So going forward, we expect some of the areas that Chinese government will move. So we know they already started with technology and education. Next, I think they will go into some of the gambling session, online gaming. I think you can see on bullet point number 2 here. Healthcare also may be impacted, healthcare industry in China. So I really encourage all of you to conduct your review often with your advisor in Affin Bank. So all in all, we like China, but I would just send a word of advice. We need to be patient in China. It takes time for Chinese government to do all this, and I'm sure, but at the end of the day, if you focus on the long-term potential on some of these companies they offer on the trend, we are confident they will bounce back from this current temporary setback on this current policy. So I think moving on, if you can move on to the next 2 slides, Jeff. All right, so to summarize, I think before I move on to talk about some of the trends that we really like in our global portfolio, right? So if you look at our overall stance, whether it's going to be risk on or risk off, right? So the answer is a definite yes for risk on, primarily because we continue to see good growth in global economy. So I would encourage all of you today to have a risk on mode in your portfolio, right? Not too much on the bond side. So I think equities continue to be a good place to be in. As such, you can see the one in the middle, our equities continue to be bullish, while we moderately bullish right now, but overall we continue to like global equities because of the trends are still encouraging. We got good growth on the corporate earnings, and you got the big boys like the US, the private consumption continue to power the growth in the US region. Yeah. On COVID-19 vaccine, the rollouts differ across different markets globally. The Delta variants continue to be a concern, but as we speak, I think the scientific data does show that the Delta variant the vaccines continue to be highly effective against the Delta variant, because I think you look at the countries like Israel, when you do the 3rd booster, it does show that the the hospitalization rate continue to be quite low among the fully vaccinated people, right? For UK, for Israel, and even for US as well. Yeah. For bonds, I think we are bearish in Franklin Templeton. So we see some value in specific markets like high yield, but it's important. I think you need to be really selective on the bond market as well, given that the way how the bond market is behaving, how the yield is behaving on the US side, especially with what US Fed is doing right now. We think currently bond is less attractive to be in. All right, so moving on the regional or global markets view, just want to talk about US. I think we are moderately bullish on constructive on US, primarily because of 2 reasons. I think all of you can remember this. When it comes to US, it's simple. The 2 C's, right? The 2 C. The first is the consumption by their own people. So that's key, right? Consumption power 70% of US GDP. The way that we are assessing US right now, it gives us a sense of confidence when we saw the saving rate in US going up actually. You may thought that they got all their stimulus money and they spent all of it. Answer is no. The Americans are saving for rainy days. their debt level has come down. So what we've seen right now is a very strong consumer backdrop in the US, which we think will continue to power the growth in the US going forward. That's the first C. The second C will be corporate earnings. So our take is the corporate earnings in the US, first quarter, second quarter have been fantastic. Going forward, the pace of growth will slow down, similar to the economic growth, but still above trend. So hence, I think the why you've seen some of the research house out there when you read the news, they increase the target for S&P is because first Q, second Q, the US corporates have beat expectations. So analysts, what they need to do, they need to increase their forecast for the full year of this year. So that's why they need to increase the forecast of the index. So it means going forward, market continue to be supported by two Cs in the US. On Japan side, we are positive as well. I think it's actually as encouraging that we're gonna have a new prime minister in Japan, right? So all in all, Japan has always been cheap, and it's actually well positioned. Especially we're talking about a rebound. Typically, Japanese companies, because their corporates are so highly exposed to the global rebound, because they have these big giants like Toyota to Toshiba, all these big giants, they're so exposed to the global economic rebound. So we like Japan, while the earnings per share are quite not strong as other markets like US or Europe, but we think Japan is in a good position currently. So we like Japan. On China, I think we always like China, but currently, as a tactical way, we are cautious on China. So, given what's happening, not just this week, but the months before, I think the way that the Chinese government is going ahead, I think we continue to be quite cautious on China. So, on our global equity exposure, we have trimmed China just because of this ongoing risk. On UK front, I think we are neutral on UK and Europe. I think Europe has done well this year. But the only thing about Europe and UK is that their companies are very cyclical in nature, right? In Franklin, I think one of our strong thesis for managing growth for your portfolio is riding on the structural growth trends. So these elements are quite low in Europe, SUK and UK region. So their companies are more cyclical in nature, oil and gas, you got things like banks, So we are quite neutral on these both regions at the moment. So moving on to some of the trends, this is the part I think we are more excited about. I spoke about the top-down perspective of the global economy. So to recap, we continue to be positive on the global economy recovery, the ongoing, currently what we have. We are in mid-cycle environment. We have started growing massively in the global developed markets since the crash in 2020. But now we are in a mid-cycle environment, especially in the US. But going forward, the growth is still good, but it's going to moderate. But doesn't mean there's no opportunity in the global equity market, because the way market is behaving right now, yes, they are pricing in all this growth, but our take is not all the growth has been fully priced in. No longer cheap, but we still continue to be selective. And the key word here is to stay invested in equities. All right, so let's talk about the trends, shall we, Jeff? So these are the trends that what gets us excited at the end of the day, right? The markets can go haywire because of one property developer in China and will impact sentiment. But at the end of the day, if you focus on the trends here, you can't go wrong on the long run. So first, on the left, I think what we've seen here, because of COVID-19, these are the existing trends that we like, and they have been accelerated because of the COVID-19 impact. So things like digital transformation, fintech and digital payment, healthcare innovation is fantastic in the US. If without the healthcare innovation and the biotechnology companies, we won't have the solution to COVID-19 in such a short time frame, right? I think we look at the history of vaccine, it took years, Look at Ebola virus or SARS virus in 2003. It took years to come up with a vaccine, right? So the amount of speed that we got COVID-19 vaccine is just phenomenal, thanks to biotechnology and healthcare industry. Cloud computing, huge business. I think we've seen trillions of dollars piling into cloud computing. many businesses, companies, governments, private sector, all are rushing to adopt cloud. They are rushing to do that is because they were slow to do that before COVID-19, but they realized that because of this current juncture, work from home or remote working could be the new normal. So maybe Jeff and I, we don't have to be 5 days in office, maybe just a hybrid model, right? Some days you spend in office, some days Jeff can work from Bali, for example, or from Phuket. So the cloud computing is key here to enable all of you to work from home. Mobility, 5G is another segment that we've seen increased growth this year because of COVID-19 induced. So that's some of the themes that are accelerating. Let's talk about the new themes, yeah, that we are observing that is coming out. Things like we realize this pandemic has caused some of us have changed behavior, the way what you buy, what you sell, and how you live. So some example there, what things do you shop? E-commerce, for example. Maybe because of remote working, you want to buy a exercise bike you want to put at home. So there are certain company that will benefit from the exercise bike that you bought. You may want to buy few more PC from your home. So which company will benefit from there? The whole supply chain will benefit from there. So the way user behavior, the pattern will impact the growth in the themes that we've seen here. So whether it's online shopping, in-home exercise, entertainment, travel, and even the way you consult your doctor. So you don't have to see your doctor in person. You can actually do a telemedicine consultation, right? Your doctor will give you an online prescription for you to go and buy the medicines. You don't have to go to hospital. So these are the trends that are emerging. On healthcare side, I think we've seen a lot of fantastic advancement on genomics, biotech, emerging pharmaceutical and medical technology companies. So we tend to look at these few areas within the healthcare innovation. On the industrial side, I think what we are seeing the companies, especially the ones in the US or even in Malaysia, some of you are in the corporate world, you realize that why the industrials are rushing to replan the way they do their supply chain, right? Maybe they find out their way is too old school before this. Now they need to install certain software to manage their inventory rather than to hire 5 staff to do one task. They automate by doing software. So these are the things that are changing the supply chain in the US especially. The other trend that we're seeing, Jeff, is that people are moving away from cities. So this is what we call de-urbanization, right? Especially on millennial group like you and me, Jeff. Instead of living in KL, we are moving away to Seremban to live, and you can work from home already. You can work anywhere. So this the same trend we are seeing in the US, whereby people are moving away from the cities to suburbans, for example. So that could create a lot of investment opportunity, we reckon. Maybe you want to buy this particular consumer or a company that will benefit in that particular area, right? So maybe a restaurant chain is something that we want to look for in our portfolio, right? So these are the things that we've seen trends are emerging. Hopefully, all of you like what we are trying to do here. But if you look at the next slide here, really, I think on the earnings growth projection on the US front is healthy. So I think later probably some of the question will ask what will be the outlook for US market going forward. So our take is the earnings growth on the US front continue to be healthy. So you can see the breakdown of the sectors here. Consumer discretionary. So I mentioned about consumer sector, real estate, looking good out there. You look at IT, you got communication services. Communication services in a way is IT as well. So you can see both communication services and IT are growing very well. And as expected, some of the sectors like utilities are quite low growth in nature. Good bump, 5.9%, but relatively quite low compared to the rest of the sectors here. So it's important to be selective, like I mentioned earlier on. So I think all in all, our take, I think just to emphasize our preference for equities, global equities, is because look at US here, right? The bond yield currently in the US is about 1.3%. Their 10-year government bond yield. Equity yield, despite a run for the last 1 year, continue to be a good gap, right? the equity yield divided by bond yield. So you can see this slide here. Currently, we are about this level. That is despite about 15 to 20% growth in US market this year. The gap is still healthy compared to bonds. As such, we continue to be positive in US equities. We think it's more compelling asset class to be in. So moving on from US, let's talk about sectorial, the trends that we've seen, right? So I highlighted some of the trends just now, but on the technology, lucky or not, this is the trend that is happening right now. Look at the investment on the US private fixed investment into software, technology equipment, and R&D spending as of percentage of the total private fixed investment. Currently is more than 50%. Look at the growth since 1960, from just under 15% to today, more than 50%. So this is very prevalent in such that even Microsoft CEO Satya Nadella has mentioned that when you look at the total technology spending as opposed of the world GDP, currently is about 10%, right? But he's seen that has doubled already to 20%, right? And what about the next many years beyond? So as world GDP expands, we think the total percentage that goes into technology will also grow. So the chart in front of you is a good one to indicate that the investments as the percentage of private fixed investment is growing at a very healthy rate. So we think this is a long runway for growth within the technology sector. These are the key pillars of the digital transformation that we see. So I think what we like is that some of the things with regards to software as a service, cloud computing, digital customer engagement, fintech or digital payment, Internet of Things or electrification, 5G, cybersecurity, or future of work, collaboration between among your staff, and AI or machine learning and analytics and new commerce. These are the top 10 sort of this is the Bible of our digital transformation playbook. So when we want to buy ideas associated with digital transformation, our strategy is go back this playbook and we'll buy the best names from each of these segments. So if you're interested to explore the solution behind this, I think Affin does have a solution that is associated with digital transformation. So going forward, we think the technology or digital transformation growth is not the end, right? Just because you got vaccine, you don't use technology, that's not true. So we think digital transformation growth is just at the beginning, it's just starting. So yes, because of the pandemic, some of the spending have been brought forward, but the way we adjust or whether the way we view our take on the future growth continue to be intact in our view. So when we check with our network in the US, we check with the industry buyers, the investors, we continue to view that our investment thesis is remain intact. And we think the growth is just starting and will only continue to grow. So it's important as an investor, you ride on these trends as a long-term wealth creation for your portfolio, right? So this is a sector, digital transformation, technology, important sector you need to have as a part of your core portfolio moving forward. So that's the first trend that I want to highlight today. Finally, I think before we break into Q&A, on the healthcare side, I think we are particularly more excited about the biotechnology sector. I did mention about the role of biotech plays during the COVID-19 crisis and the fact that we have vaccines so soon. So, just apart from the vaccination progress, outside of the sector, we still have so many innovations are happening, whether it's the next cure to this particular cancer, whether it's to address the cardiac disease or respiratory syndrome, so much more, right? So you can see some of the growth that will continue to propel the growth of biotech sector in the years to come would be demographic trends. We've seen increased R&D spending, and we got strong innovation happening within the sector. So that is why we call this sector as tomorrow discovery as a today's opportunity, right? So what if currently what we have on mRNA vaccine with COVID-19, imagine if the vaccine can be expanded to improve our flu vaccine, for example, right? To come up with vaccine for Ebola or Zika virus and so many more viruses. So vaccine platform, very important. I haven't talked about the gene therapy platform, right? So gene therapy, some of you who follow the healthcare world, I'm sure you heard about the hype on CRISPR, the gene editing platform, the genomic research. So all these things plays into the picture, right? The DNA sequencing, genome sequencing, all this plays a very big role in terms of the innovation in healthcare industry. So that summarizes why we continue to like healthcare innovation and in particular the prospects about biotechnology sector. I think just talking about innovation, I think we are encouraged by the growth of the drug approval. So as you know, biotech companies, what they are trying to do, right? They're trying to discover the next cure to this particular disease that is impossible to treat in the past. So you look at the drug approval here over the last 10 years, it's been growing steadily despite some blips, but overall it's still a good uptrend for drug approval. So if you've been reading the news, you know, like last few weeks or last few months, this company, this biotech company name is Biogen. So they have announced a drug that was approved by FDA that is going to slow down the Alzheimer disease. I think Alzheimer is one of the top common disease out there. So the moment you got Alzheimer, I think you know what will happen, right? Some of the old folks, you know. So this particular drug by Biogen can slow down the Alzheimer spread. So it's very encouraging, and it's the first such drug that is able to slow down the disease. So that's on Alzheimer. And certainly, I think you can see a lot more growth coming from on the cancer platform side. I think on the oncology side, there are many platforms, whether it's the using a body immune system to fight with cancer. So we call that immuno-oncology. Yeah, that's one. Second one is what about if we can do a targeted treatment? So we call it precision oncology. So there's so much more within biotech that I would love to talk about it in a specific session. But by and large, I think within healthcare, I would like to encourage to all of you focus on innovation, and we think that is very prevalent in the biotechnology sector. So I think as a key takeaway for today, I think before we move on to Q&A, three simple key takeaways. Quality. I think I mentioned a lot about quality. Market is going to be very selective moving forward. We think the growth in global equities will continue, but market will likely favor companies are high quality, right? With earnings that is sustainable, good cash flow, right? Business model that is robust or strong, and most importantly, exposed to the key growth trends like digital transformation and healthcare innovation. Which comes to the second point, while I think certainly there's concern about sector rotation earlier on, right? Whether you want to buy more cyclical, whether you want to buy more growth. At the end of the day, I think our advice is focus on the certainty, right? Rotations may happen every now and then, right? Because of external factors like interest rate environment. But at the end of the day, you can't go wrong if your portfolio is exposed to the long-term secular growth trends like tech, biotech, these are the examples I mentioned today. And there's so much more, right? Whether it's the blockchain technology, whether it's the fintech, so much more. So it's important to expose to these key trends and the new economy businesses and companies that I highlighted earlier on. Last but not least, I know we tend to repeat this a lot, Jeff, but stay diversified and stay active. Continue to rebalance your portfolio often. And no doubt, I think currently global markets at a new high. While in the last 1 week, it came down a little bit. But by and large, our positive view for global equities continue to be intact by virtue of the factors I highlighted today. From the US front, it's very strong. On the European side and the Japan side, we are more favoring Japan. European and UK, we are quite neutral. In Asia, we like certain markets that are resilient. So it's important to navigate the global markets, consult your advisors in Affin Bank, which market you should be exposed to for your long-term growth for your portfolio. We can do more questions and answers in the next session, but Why don't I stop there, Jeff, and pass it back to you.
Thank you, David. First of all, thank you very much for recapping the whole thing into just a short slide and just a short statement. Yeah, which area we are overweighting, which area we are underweighting. Now, as we have come to the Q&A session, dear value client, you may post your question in the chat box, or you can actually send your question to your respective relationship manager. Bear in mind, we will try our best to attend your question if time permits, or if not, our relationship manager will get in touch with you personally. Yeah. So of course, as part of the registration process, we managed to compile a few frequently asked questions for David. I think David know about this question lah, and this is very relevant to the topic today. So David, question number one, which is the most frequently asked question: is there any room to run for US equity since they are currently at all-time high? So anything you would like to re-emphasize on this statement or this question?
Sure. I think, Jeff, if you can move on to the next two slides. But I think overall, what our take on global equities, right? It's important for all of our clients today to remember there is no correlation between market return and valuation. I repeat, there's no relationship between market return and valuation. Just because market is record high doesn't mean it can't go up some more. It's all go back to fundamental. Remember, fundamental for US will be the two C I mentioned, consumer and corporate. So that's for US. Different market, different sort of factors, right? But you can see here, back to your question, Jeff, right? Global markets a new high. What's next? The answer is go back to fundamental. We assess the factors that is driving the growth in global equity market, and the result is, if you look at the slide in front of you, this is on the global equity risk premium. So in the layman perspective, the higher of the risk premium, the better it is. How do we get this figure? Simple. Equity, the risk we adjust against the bond risk. So the higher is, the better, right? So because the recent 1 year, the premium has come down, it's because global equity run a lot already, right? So that's why the title of my slide here, of course, it's not cheap, but still attractive, relative to bonds. So in this current environment, where you're gonna park your money, right? So we believe equity would be the sweet spot, right? And we don't see a bubble, especially in the US, because it's supported by strong two C's that I mentioned just now. So if we look at the next slide, this is for the US. I showed this earlier, but just to re-emphasize here, right, ladies and gentlemen, if you look at since the GFC crisis, look at '08, right? The yield go up because the market crashed. Subsequently, we got strong recovery. The yield gap between the equity yield in US divided by bond yield came down, and it gone up again. So over the last few years, we were in the longest bull market, right, in this previous cycle, only to be ended by COVID-19 recession. But fast forward, because of the swift action by the US government and the central bank, they bring out US out of recession in the shortest, actually in the quickest recovery ever, right? If you follow the S&P 500 index, I think March 2020, it crashed to, I think 2 to 3,000. Today, it's 4,300 already. And market are forecasting higher room to grow going forward. So I would say, Jeff, the way to answer that is go back to fundamental, what's driving the market. For US, we've seen the factors are healthy, and same goes for rest of the market in the world. Asia, resilient economy, and Europe and Japan. I think we are more favored into Japan right now, right? So by and large, focus on the fundamental. And last but not least, there is no strong relationship between market return and valuation. So just don't look at valuation as a single lens of view. You need to judge based on what's the interest rate environment, bond yield. There's still a lot of liquidity out there. So while Fed may pull back this liquidity, but it will be on gradual basis. They don't want to shock the market. So all in all, our take is we still think global equity is more attractive compared to bonds.
Thank you, David. David, you mentioned about the 2C consumption and also corporate, right? So basically, what are the impact on the US tapering on developed market and also on Asia? Will there be any market correction on that?
Yeah, I think Fed tapering, I think Fed, first of all, Fed has well communicated that to market. So last Fed meeting, they told the market that by year end, they will start taper. Taper in a nutshell means they reduce the bond buying monthly program. Currently, I think it's 120 billion per month. So they plan to reduce that gradually. But interest rate hike, Fed has not really committed when. I think they put a targeted timeline, which is, if I remember correctly, second half of next year, or is it early 2023 lah? But by and large, Jeff, if you look at the tapering, whether let's say if the monetary policy will be tightened in the future, at the end of the day, I will ask all of you, what's the reason Fed want to pull back this liquidity? It's because economy have rebounded and is booming. So similar to the analogy of, let's say, Jeff, let's talk about a patient, right? That is on a life support in ICU. You need the ventilator, all the support, right? But when you recovered, is it okay if I pull back the ventilator support? Yeah, so that's what happened to US today. So it's important to remember that, tapering may happen by year end, well communicated to the market. And the important thing to remember is that it will be on a gradual basis, sort of pull back the liquidity from the market. So our take at the end of the day, we think the market in the US, especially when the tapering happen, the companies are able to absorb this shift in monetary policy. But of course, there could be volatility if the communications confuse the market. For example, that's what happened in 2013, right? Taper tantrum when Ben Bernanke, the ex-chief, I think that's something that he said spooked the market. So, but currently, you can see the current Fed administrations are quite world class in terms of their communication to the market. So far, if you judge based on every time Fed got meeting, so today I think Fed got meeting, Jeff. So far, I think market is reacting quite positive on the way Fed is behaving this year. So it's a strong indication that they are comfortable with the policy that Fed is laying out for the next medium to long term. Hopefully that helps, Jeff.
Yes, it clearly specified what we would like to know. Yeah. So basically, will there be any regulatory crackdown as a concern to the tech stock? I think this question will be more related to both US and also China. So in terms of all these regulatory crackdown, should we wait or maybe should we actually stay invested?
I think I would tackle that question by asking all of you to take advantage of the volatility contributed by the crackdown. Let me tell you why. Starting with China first, our take is yes, I think the rule of law is different in China and the US. So some of you may ask, will this China crackdown spread to the US? Not really, because US is already doing crackdown since many, many years ago, but their style is different. But let's go back to China first, right? So our take is the rule of law is different in China. The intention is not to kill down some of these tech companies. The intention is to just to regulate. But the way they doing it, the way they're communicating it, tonight they announce, tomorrow the policy start effective. It's quite messy, right? So hence our take is we still like the Chinese tech. We are quite focused on select few companies, right, that are positioned for long-term secular growth, the likes of Tencent and Alibaba. These are the names that we really like. So we continue to eye for opportunities to even accumulate more in these large Chinese tech companies. So, but the key thing is to be patient, right? If you buy in today, you need to be patient. The returns won't come immediately, right? So this for Chinese tech. On US, I think it's important to remember that the US system, the rule of law is very clear. It's based on, have the tech companies do any harm to consumer? The answer is actually quite debatable. At the end of the day, the tech companies that US, the product and services are provided free of charge to all of you. Come to think of it, Jeff, I think Facebook doesn't, I think the boss, Mark Zuckerberg, doesn't force you to use his Instagram or WhatsApp. You are welcome to use another platform if you don't want to use WhatsApp. It's a free market system, number one. Number two, competitors are welcome in the US market. It's a free democracy, free country. they welcome competition. So because of that, it's hard to debate whether the tech companies cause a harm to market. Privacy, yes, Jeff. I think Facebook have addressed this issue. 2016, remember when Facebook was stuck in a Cambridge Analytica scandal, only to see that Facebook share price dropped quite significantly. But look at where Facebook is today. They're not only rebounded, but they are at the record, higher than the level in 2016. Why? Because Facebook is still doing well. And they have said this, right? They are invested billions of dollars to improve the security of their social media platform. So privacy side, yes, the companies in, especially the large tech companies in US are addressing this. So back to your question, all in all, we think the regulatory concern in US is an ongoing issue. So especially that given the new government also is going to be quite proactive in regulate the big tech in US, but by and large, we don't think any sort of potential regulation will impact or derail the growth of the US tech sector. So in any case, if there's any short-term volatility happen because of some announcement on regulatory crackdown, I would encourage all of you to take the opportunity and call your relationship manager.
Thank you, David. Due to time limitation, maybe we'll end with the last question over here. All right. This is very much related to Evergrande. So we pertain to what happened to Evergrande this week particularly. So what is your view in terms of China and also Asia Pacific REITs?
Yeah, that's a very good question, Jeff. So let me address what happened to Evergrande, right? So one of the largest property developer in China. And when we look at the main concern, right, that actually caused even the US markets to fall on Monday night, would it cause global contagion? The answer is unlikely, because we look at two things, right? Evergrande exposure to the total loan exposure in China, the total banking exposure in China, number one. Number two, we assess in terms of the Evergrande exposure to the total property exposure in China. Both are quite low, single digit exposure. So that's the good news. So unlikely we will see a contagion like Lehman Brothers. Remember, Jeff, like 2008,
Yep.
this is the cause for the crisis, last crisis. So unlikely we will see global contagion. That's number one. Number two, you may ask me, what will the Chinese government do going forward? So our take is we are not speculating what they're going to do, but our view is given that property is such an important sector in China, there are many stakeholders in China because of this property segment. So that includes the property developer of Evergrande, right? So our take is there will be a sort of a rescue will be coming in, right? So we don't, maybe the rescue won't be in the full-fledged rescue, but it will be in stages whereby there will be creditors, for example, etc., etc. It will take a long time for this to be fixed, but by and large, if there is positive news on the tone of change from the government with regards to this particular property developer, we think that will improve sentiment on the property segment, real estate in China, and to your question about the REIT market in Asia. So remember, on the trend on REIT, right, it's because they're all riding on the trends about growth in property market, right? But if you're investing in REIT because you like the yield, right? So the particular fund has a yield or REIT is because the underlying is growing, right? Whether it's a mall like Pavilion, whether it's a mall in Vietnam, and etc. Go back to the fundamental. Do you think this case will impact the growth of commercial REIT in Asia? So while there may be sentiment selling in the short term, but maybe it's a good opportunity to pick up some good REIT. They give you a good yield, right? But to be careful, what's the underlying, right? So if it has real estate China, you are probably will exposed to short-term volatility until there's a solution on the Evergrande front, right? So it's important, to really reassess whether this issue will spread into contagion globally. The answer is no. Yeah.
Thank you, David. I think you have answered one of the most important and most frequently asked questions for the week. because recently there are a lot of news that tends to relate what happened to Evergrande to the Lehman Brothers collapse back in the subprime crisis. Yeah, so I think you have actually answered quite clearly that all this what is happening towards Evergrande won't give a significant impact as what has happened before. Yeah. So with this, thank you very much, Mr. David. And before we end, please give me like a 5 minute to share with you what is the current promotion that we have here in Affin Bank. So for clients that like to invest and at the same time opting for fixed deposit rate that is at a higher pace or higher rate, note that we are offering FD special rate of up to 16.38%. You heard me right, 16.38% with our wealth deposit campaign. Yeah, and follow up next for all guests that are having birthday from September to December 2021. Well, happy birthday. We are offering a gift of wealth by a flat 1% sales charges on our unit trust. And last but not least, if you are already our Invicta client and or if you are not yet an Invicta client, but you're interested to join us as an Invicta client, do take this opportunity to get your Nespresso coffee machine and 100 ringgit Shopee e-voucher when you invest with us either in the unit trust, Amanah Sham variable pricing, gold investment or banca assurance product at a specified investment amount. So with this, thank you very much for your time. Also, thanks for Principal Asset Management and Mr. David from Franklin Templeton for making this event a success with us. Thanks, and may everyone stay safe. Thank you.
Take care, everyone. Bye bye.